Hi, I want to continue with the last exercise that we solved last time together, but this time I want to change one thing, okay? It's that the asset will be disposed at year 5. So this is the key word, okay? Disposed at year 5. When you see this word, you'll have to know that I'm gonna adjust the rate at year 5 multiplied by half and then modify the calculations. Okay, here nothing has changed except for that when I have disposal before the end of the useful life of the asset, I will have to get the book value at the same year, and I need to calculate the gain or loss on disposal and still see is it still a good investment or not. So I want to modify the table. It will look like this. Since I will dispose the asset at year 5, this means that I will stop at year 5. Okay, nothing beyond year 5. Everything will have to be eliminated. But we will keep 2 rows for year 5, one for the annuity and one for the market value. Now the cost basis is still the same, the rates are still the same except for the rate at year 5. Since I'm disposing at year 5 and I don't know did I dispose it at the beginning of the year, at the end of the year, so since I'm not sure, I'm using the half-year conventions. This means that I will assume that the asset will be disposed at half of the year, so that's why the rate that I will get from the table will be multiplied by half or divided by half. And you will continue with your calculation normally. You will still have to calculate the depreciation deduction. You will multiply the value here when I subdivide it by 2 with the cost basis. You will see, since here the rates are the same, you see that this value is about half of this value. You will have to calculate the taxable income. It is A minus B, this value. Then this value you'll have to apply the tax over it again, the 38%, and then you will have to calculate after tax cash flow, which is the value here minus the 9,000. Now what do I have to add? We have to add the gain. The position of the gain is placed here because it is a taxable income. Okay, we used to say previously when we have no disposal, the gain will be always 0. It will be the market value, okay, minus the book value. Since when I have no disposal and I use the asset till the end of its useful life and I use all the rates in the table, this means that its book value will become 0. This is when the case where I have no disposal. Always when I use the asset beyond the recovery rates, I use all the rates from the table, all of them, the book value will become 0 at the next year. So always the gain without disposal is the same as the market value because it's the market value minus book value, which is 0. But when we have disposal, this means that I didn't use this asset till it has been fully depreciated. So it still has a worth. So it has a gain. It should have a gain. So it's very important to calculate the gain here. So in order to calculate the gain here, I have to calculate the book value at year 5, then subtract it from the market value. And this gain will be, I apply the tax on it, and I will create the new after-tax cash flow. Okay, let's see how do we calculate the book value and the gain. Just remember that you will have to calculate the book value even if I didn't mention it in the question. Anytime you have a disposal, at the year of disposal, you will have to calculate the book value at the year of disposal in order to calculate the gain at that year. Okay, so I shouldn't tell you, you have to calculate it yourself. By default, when we have disposal, calculate book value and the gain at that year and apply the tax on the gain because the gain will be, in this case, different from the market value. If I want to calculate the book value at year 5, it is the cost basis minus accumulated depreciation. This is the cost basis, $180,000. Okay. When I apply the equation for the book value, please put the cost basis in the positive sign. Okay, don't say it is minus 120,000. I just use the sign only when I want to calculate the present worth of the cash flow diagram, just to indicate which is gained, what is paid, and so on. But with the book value, I just want to see what is the value by books this year. So this is the original cost basis. Keep it in the plus sign. Now I want to subtract what? The accumulated depreciation. So this means that I will calculate the depreciation for year 1, 2, 3, and 4 for all the previous periods before year 5. So at year 1, the book value was, for each year, the depreciation is the cost basis times the rate that I get from the table. So this is for year 1. And I'm calculating the accumulated depreciation, so I have to add them all together. So it is 180 times 0.2 plus 180 times 0.32 plus 180 times 0.192 plus 180 times 0.1152. So that's why I took the 180 common, okay? And I opened a bracket and I added the rates. You see here, the only difference at disposal is that the rate related to year 5, this is 1, 2, 3, 4, and 5. This is the rate related to year 5. It is divided by half, okay? Divided by 2 or multiplied by half. So this is the book value at year 5. Now what will be the gain? At year 5, it is the market value minus book value, both at year 5. It's the $30,000 minus the value that I calculated. So this is your gain. Now I want to see, is it still a good investment? So this is your last column, okay? After I applied the tax over the gain and I calculated after tax cash flow. This is the last step. I want to calculate the present worth of this new cash flow diagram. So the present worth at 10%, which is the after tax MAR, okay, is the minus 180,000. This is the initial investment, plus 36,000. This is at year 1, so far away by 1 period. So I multiply it by P knowing F, 10% 1. This is far away by 2 periods. Okay, so this is the equation. This one, 3 periods. You see? At year 4 again. At year 5. But the most common mistake that students do here is that when I'm calculating the present worth of this, which is related to the market value, they will put it here as P knowing F 10.6. Okay? Calculation mistake which is done on a hurry. Okay, but don't forget that both these values are happening at year 5. It is the annuity at year 5 and the market value at year 5. So you can join those two values and multiply it by P knowing F10.5. All keep them separate, but don't forget that N in each case is equals to 5. Okay, once you get the value of the present worth, if it's positive, then this is a good investment. Negative, then this is not a good investment after paying the taxes. So basically, this is what changes when you have some disposal. The only thing that will change in the table, again, is that we clear everything beyond year 5. The rate at year of disposal divided by 2. And here, instead of the market value, instead of 30, you will have to calculate the gain, apply the tax on the gain, and get its value with respect to the after-tax cash flow. You will get the new after-tax cash flow. Because what I see students do is that after they calculated the gain, okay, and the income tax here, they will not get the final answer for year 5 for the market value here. They will forget this step. So when they do the present worth of this cash flow diagram, it might be negative, and this will indicate that this is not a good investment, and it is the opposite case. So please pay attention. Thank you for listening.